Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. On today's show, we are joined by a very special guest, Upasana Chachra, the Chief India Economist at Morgan Stanley. Welcome, Upasana, to the show. The context really to the conversation, viewers, is 7.6% GDP growth rate recorded in the second quarter, a stupendous number, a number that has beaten all estimates, a number that was not at all expected, although the government, the finance ministry, had dropped some hints a few days ago by saying that economic activity was doing far better than what had been estimated, and that's a message that has been repeated even after the data came out, but we'll come to that later. I want to begin with you, Pasna, on the number, and really it's the double-digit growth in three sectors that seems to have driven this. Agriculture has suffered the vagaries of weather. What's the best way to understand this data for the average viewer? And as we are on the show called Easynomics, make it easy for our viewers to understand what really has happened.
Sure. Thank you, Siddharth, for having me on your show. And surely the growth numbers that were released yesterday for September quarter have surprised on the upside quite massively, beating consensus R and RPI expectations as well, coming in at 7.6%. As you mentioned, the upside surprise is being driven by very strong performance from the more broadly speaking, the industry segments. So if you look at manufacturing, mining, construction, electricity, from the GDA or the supply side of the data that we get, those all have been growing above or at double-digit levels in real or volume terms. So that's a very good performance that we've seen from the industry segments. That has basically accounted for the upside surprise that we got yesterday. On the other hand, again, as pointed out by you, agriculture growth has been weaker this year, this quarter, reflecting the impact of El Nino and erratic weather and rainfall that we saw in the on last concluded monsoon season. Government's first advanced estimates for food grain output for summer crop are also indicating a decline in volume terms, although marginal, but that has weighed on the overall growth that we saw from the agriculture segment. Similarly, on the services side, while growth remains pretty healthy, it has been weaker than what we saw in the June quarter, impacted by base and some amount of sequential slowdown. On the demand side of the breakdown of the data, we see that again, similar to what we see on the supply side, it's basically being driven by capex. So gross fixed capital formation growth at 11% is again at a 5-quarter high. Similarly, government spending remains pretty robust. It's going double digit. And that has been the main drivers of growth from the demand side. At the same time, private consumption has weakened again in the September quarter, and it remains a little low in terms of YOY growth. But nonetheless, we can't take it away. The GDP growth for September has surprised us positively. And basis that, the full year fiscal 24 estimates have seen a bump up. We have revised our numbers as well to 6.9% for fiscal 24. So just very close to 7 handle now, from 6.4% that we were looking at earlier. And we do think that even as the second half of the fiscal 24 sees some moderation in YOY growth rates, that's more like optical, because the sequential run rate will remain quite robust, supported by the domestic demand or similar factors as we've seen in the first half.
Right. So Morgan Stanley upping its forecast full year to 6.9% versus 6.4%, and viewers, almost every economist, brokerage has upped the GDP forecast. So that's one of the immediate consequences that we are seeing. In fact, Citi, just to rattle off a few, Citi upping it to 6.7 from 6.2, SBI at 7% versus 6.7% earlier, Kotak Institutional up at 6.9 versus 6.4, Goldman Sachs up at 6.7 versus 6.5. So the range is diverse. Somebody is hiking it by 20 basis points to 50 basis points, and perhaps there might be more also. That's the immediate aftermath. But Upasana, before we go into a much broader sort of 2024 outlook, basis this data, basis this performance, what are the implications implications. And if you could explain it from 2 points of view, what will it mean for the government and its next year sort of program? We know that the budget will also be more tending towards a regular budget than an interim one, and the RBI and its inflation control strategy.
So the implications of this growth number are mainly, so it basically indicates that domestic demand remains very robust. So as I mentioned earlier, you see all the industry segment numbers are very strong. Services are tad weaker versus last quarter, but not like really slowing. And at the same time, capex growth remaining very, very strong as well. So in a way, it's a good mix because what we're seeing is that the supply side of the economy is responding. So we have higher growth rates in construction, in mining, in electricity, and all that bodes well from a supply side perspective because even as demand continues to pick up, it means that supply is also responding positively. And therefore, from to your point on implications for RBI, it's not going to be as worrying because it's a healthy mix of growth. So, i.e., this growth is not really going to impact the inflation trend very adversely, or it's not imminent of aggregate demand pressures or heating up of the economy, and that forcing the RBI to react. Um, so from just the growth perspective and what it means very quickly for the government and for the RBI, for the government, I think it definitely does look like they are working with a real GDP number of 6.5% for fiscal 24. So it is likely that we will be seeing the number to be higher than that. So that bodes well from a fiscal management perspective. And we also had the fiscal deficit data and the fiscal numbers released yesterday for the first half, or rather April to October. And again, the fiscal deficit management remains on track. So fiscal risks are not like imminent. And with a better growth trend than what they were budgeting, that picture looks much better. And from an RBI perspective, as I mentioned, economy is responding from the supply side as well. And therefore, there's always fear, right? When you see high growth numbers, that will it stoke core inflation pressures? And, are we looking at some sort of inflationary pressures down the road? But I think this number is not indicating to that trend, and therefore I think RBI will probably continue to sound cautious given where we are from an external uncertainty environment perspective. But at the same time, the need for any rate action is not really there, and the bar remains quite high for any monetary tightening in our view.
Okay, viewers, I'm going to now discuss the outlook report that Upasana has and team have done at Morgan Stanley for 2024. But before we ask her about that, I want to get you to hear what the Chief Economic Advisor in the Ministry of Finance had to say after these numbers came, and then we'll continue discussing with Upasana. Let's take a quick listen in.
We are probably still underestimating our GDP growth and economic activity. Contrary to several prejudices which masquerade as opinions, the truth could very well be that India's GDP growth may be, based on our current statistics, we may be understating them rather than overstating them. In terms of the projections, therefore, obviously these numbers impart a certain upside to the 6.5% estimate for real GDP growth in the current financial year, but we will have to work the numbers to see what kind of upside that this current numbers impart for the full year estimate. So until then, we will keep the estimate at 6.5%, except to signal that we are now probably more comfortable with this number than we were before.
That was the Chief Economic Advisor reacting after the data. And remember, viewers, the government has certain preliminary access to these numbers, so clearly very well prepared. The Morgan Stanley report, the narrative for the year ahead outlook basically has said that we maintain our constructive view on the economy supported by strong fundamentals. So Upasana, the first question that you have asked, and that's the one that I want you to explain to our viewers, your conclusions and your outlook there. Will private consumption growth gather pace?
Yeah. Yes, I think, when we discuss India's macro outlook with clients and have relay our constructive view. Some of the debates are centering around consumption also now, and not just on capex. Usually it's more capex, but there's also some concern around consumption, because we do see from some of the corporate commentary as well that rural demand or that segment has been weaker to adjust post the pandemic. Similarly, low income segments or lower value added, low ticket items on the consumption basket we have seen some amount of weakness in terms of demand, and there is some sluggishness in that segment. So there's always this concern, mainly whether rural and urban demand will finally converge, and is private consumption growth finally going to be more broad based and even. So in our view, what has impacted this, or what has led to this sort of too lopsided growth in consumption is that firstly, the impact of the pandemic on the low income segments or the rural economy had been far greater than what it has been on the urban or the upper income segments. Secondly, the impact that this segment again faced after the pandemic related disruptions were opened was also from the adverse inflation outcome that we saw in the last year or previous 12 months. And that was a unique form of inflation wherein commodity price inflation was very high, and that actually adversely impacts the terms of trade for the rural sector. So the two impact of the pandemic and the slower healing of and the normalization of the labor market for that segment, alongside, on top of it, as the healing started taking place last year when the economy opened up and services sector also opened up, which is the primary sort of source of livelihood for the informal segment or the group segment. There was this issue of inflation as well. So it hasn't been a smooth recovery path for that segment, and therefore we think that. As those disruptions are more in the rearview mirror from here on, the trajectory on inflation is improving. The terms of trade for rural segment is improving. Labor market conditions have started to normalize and are almost back to pre-pandemic level, whichever we cut it. Um, and consumer sentiment is improving. So we think that the gap between rural and urban will normalize, and urban rural demand will pick up from here on. I think the key risk over here from a next year perspective will be weather, because that has been again a factor that at least impacted sentiment adversely in the last quarter again.
The second major point that I want to ask you, and you touched upon this earlier, this is to do with private capex. Do you expect a recovery? And much of the heavy lifting has been done by the government's public sector capex. Will that continue?
Sure. So yes, I think the recovery post the pandemic has been unique in a way that it is being led more by capex than consumption, if we see, and that is being driven a lot by the government's change in strategy in terms of how they are spending. So the central government capital spending has been rising double digit, as a percentage of GDP. The central government capex is tracking at 18-year highs, and it's budgeted to go towards 3.3% of GDP this year. Um, so the government has really, counter-cyclically provided that support to the economy post the pandemic through its own budget. So that trend is what has held up the capex line item right now. Alongside, we are seeing some improvement on the private capex. Over here, we see, I would say, private capex if I also include household capex. So we are seeing an improvement in the real estate demand. New residential real estate sales are tracking near all-time highs in absolute levels, and that is getting reflected in the construction activity indicators, and as we saw in the last quarter's numbers as well. Again, if we were to look at only private capex numbers, so over there, I would say it is at nascent signs of recovery. The extent of recovery that we've seen in the September quarter, electricity, construction, manufacturing, all growing double digit, it does indicate that some amount of that is coming from the private sector's contribution as well. If we even look at it from other data perspectives, so say CMI's private projects under implementation, again the growth rate over there has been improving consistently in the last few quarters now. And similarly, capacity utilization rates for the manufacturing sector are consistently improving and tracking above long-term average. So I think all of that coming together does indicate that private sector capex activity will improve as we get into fiscal 25. It's currently at nascent stages, I would say, so we are not in advanced stages of expansion definitely, but all the indicators bode well for it to pick up. Similarly, on the government capex, I think that will remain on track in our view. We are already seeing that in terms of high frequency data for this year, and I think for the next few years as well, we are optimistic that public capex will continue to grow at least above nominal GDP growth.
One of the negative things that is happening is what is happening globally. And because close to 23% of our GDP comes from exports, both goods and services, we are seeing a decline in services. IT firms, for example, the numbers that are coming through clearly reflect that, and so is it true also for goods. So is the external sector the major cause of worry as far as the outlook is concerned?
So you are right. I think most of the risks or most of the concerns are emanating from external factors at the moment. For if you have to think about India's macro outlook over the next 12 to even 24 months, I think the domestic economy is in very good shape. Domestic demand is in good shape. Domestic macro stability indicators like CPI, current account deficit are in pretty good, comfortable range. So the risks, both from growth or on macro stability, are emerging more from the external side. So more specifically to your question on growth, yes, exports to GDP is around 22-23%. So it's not a very small number, even though India is a quintessential, domestic demand story. But nevertheless, export numbers do matter from a capex and from a capacity utilization perspective as well. What we are seeing is that, some amount of that slowdown is already there in the numbers. So even say for the June quarter, for the September quarter, sorry, net exports was a big drag on the overall GDP, but the domestic demand remains so strong that it is able to provide an offset. So, as per our global team's view, global growth will be around 3% this year and then moderate to around 2.8%. So, if you look at the numbers, it's a little range bound. It's not showing, we are not in the camp of a hard landing in US or a recession in the US. So, I think that is, what we are building in our numbers as well. We think that exports would probably start stabilizing probably in the second half of next year. And the drag from exports will therefore reduce as we probably think about fiscal 25. But at the same time, it will not be a big driver of overall growth, and the key driver will remain domestic demand. The key risk will be if global growth conditions are worse than what we are anticipating. As I mentioned, we are not in the camp of a US recession. So I think that will be, the tail risk if it were to emerge.
How is 2024 expected to be as far as inflation is concerned in India?
So I think inflation numbers are expected to moderate gradually. We see it more or less range bound around a 5 to 5.5% handle. If I have to think about the whole of CY24 or fiscal 25 trajectory, more closer towards 5% on an average basis. The risks will come from weather-related impact on food inflation. Food has a disproportionate weight on CPI and therefore can impact headline inflation adversely if that sort of a risk pans out. But having said that, I think those sort of shocks should be transient and also short-lived, because we are seeing that the government or the policymakers' response to those type of shocks is getting more nimble, and they are able to address those more quickly. So, like in the case of tomato price spike that we saw, there was a decent amount of response from a supply-demand management perspective, and the shock subsided quite quickly. So I think while food inflation risks may remain and they remain live, they are not overtly concerning us at the moment. And the good part is that what we are seeing right now is that core inflation has been moderating. It's currently tracking at a 43-month low at 4.3%. And in our forecasts, we see that more or less range bound, or say adjusted for base effects closer to the 5% or 4.5-5% handle. So core inflation being quite range bound bodes well for the inflation outlook.
The recent trends that we are seeing in crude oil prices, and the fact remains that the government has not passed on the changes as far as the end consumer is concerned. Given that, do you expect fuel prices to also play a significant role, if not for the full year, but at least in the near term, maybe the next 2 quarters?
So I think fuel inflation, will get impacted by what happens to global commodity prices, and then of course the government's strategy of how it wants to manage that, especially from an inflation perspective. What we've seen in the last now almost 18, 19 or months is that, or because the last price adjustment was in May last year, is that the government is not passing any of that volatility to the consumer or the real economy as such, and prices are at the pump level sort of pegged at somewhere close to $90 per barrel. So of course, as crude oil prices come down, there's some amount of gain, but as they go up, there's again, that loss that these companies would be facing, but the consumer is sort of protected from these volatilities. In our view, our global or our commodity team's view is that oil prices for next year will be around $85 per barrel. So with that level of prices, and that's what we are building in our forecasts, the macro stability remains pretty range bound. So we are not assuming any major changes in the retail fuel prices, and therefore that in the near term is not a major driver to our inflation forecasts.
Since we are talking about crude, and that's a major factor across the globe, we recently saw, and you must have tracked that, what happened to yields in the United States, and the year is coming to an end. From an overall funding perspective globally, what can 2024 bring us?
So I think the September-October period was definitely a difficult one. We saw lots of concerns around US data and what that means from Fed action perspective, and so the market movements were quite adverse from a EM asset class or risk asset perspective. Dollar was gaining strength, US 10-year yields were gaining, and there was obviously concern in terms of capital flows towards EM or towards India. I think for 2024, what we believe and what our US team is also expecting is that there will be more indications of slowdown in the US economy from high frequency data, and also of indications of slowdown in the CPI numbers in US. And therefore, in their view, Fed is done with hiking rates. So this is the peak level of Fed funds rate as per our US team, and they expect the Fed to pivot and to start cutting rates from June of next year. So with that backdrop, 2024, if it was all as per our base case assumptions, then the dollar index will also not gain more strength, and US 10-year yield will also go down in 2024. Then in that perspective, the environment for EMs or for India will not be that adverse actually.
One final question, and this is to do with our policy and whether that will remain supportive of our growth, because we started by discussing the revised forecasts, including yours after the Q2. So what will policy do to continue to support the growth trends?
So, I think if we look at the way fiscal and monetary policy have panned out, especially post the pandemic, I think there's been a lot of synchronization and also focus to ensure that the growth expansion continues, while at the same time macro stability concerns don't flare up. So the government has, while the fiscal deficit was increased during the pandemic and it remains elevated even right now, compared to pre-pandemic, the mix of spending is such that it is more capex driven and therefore more growth oriented than sort of creating inflation risks. At the same time, from the RBI perspective, they have hiked rates in the last year, and obviously since from the pandemic driven lows, the nominal rates have gone up, real rates have also gone up, but again they are not at overtly tight levels that it impacts the domestic demand. So in our view, there has been very prudent management of the economy, and if we look at our own forecasts as well, with inflation expected to be 5% on a moderating path, the current account deficit to be sub 2% of GDP, that gives the policy makers the comfort and the room to manage macro policy more from a domestic growth inflation perspective. And therefore, in our view, that will be the case, i.e. the policy will be driven such that they can continue the expansion for longer, and at the same time be prudent enough such that, inflation or current account deficit concerns don't flare up and then stall the expansion. So in our view, there will be possibility of RBI to embark on a shallow rate cut cycle from June of next year as inflation moderates, and that will again help to keep real rates at normalized levels. And on the fiscal side, we expect slow-paced fiscal consolidation, but at the same time, as we discussed earlier, the focus on public capex spending to remain as well, which will be supportive of growth.
Upasana, the Indian markets reacted to this GDP booster today, and very clearly the market remains in a bullish kind of momentum. And what you have just said in terms of the US Fed a pivot in June, and also a shadow rate cut by the RBI at sometime around June itself, is going to be good news for the markets. As we end this conversation, viewers, let's bring for you what Prime Minister Narendra Modi had to say after the GDP numbers, reacting to this extraordinary strong number that came out. And that's what the Prime Minister said: the GDP growth numbers for Q2 display the resilience and strength of the Indian economy. In the midst of such testing times globally, we are committed to ensuring fast-paced growth to create more opportunities, rapid eradication of poverty, and improving ease of living for our people. So growth for more opportunities, I think that's the key message from what the Prime Minister said. Upasana, thank you very much for your time with us today, for taking us through not only the immediate aftermath of the numbers, but also the economic outlook for India for 2024. Viewers, with that, it's a wrap on this conversation, this episode of Easynomics. We'll be back with more. Do stay tuned in. Until then, goodbye.
If you like the video, do like, comment, share and subscribe.